I started my investment journey in 2019. Then I stopped. Then I started again in 2020. Then I stopped again. Then I didn't touch it for 5 years. Welcome back to another episode of Almost Wealthy. And I'm John, and today I'm going to show you exactly what that cost me. A real number calculated from real returns using my actual deposits. The number is uncomfortable, but I think an uncomfortable number is more useful than having a pep talk. Now, let me walk you through the timeline before we get into the math. In May 2019, I opened up a M1 Finance account. I had been reading about dividend investment. I saw the idea of building income over time and decided to get it started. In a amount of 4 months, I deposited $1,398. I ended up losing my job, so I stopped. Fast forward to March 2020, the market had just come off the COVID crash. This is the buying opportunity I should get back in. I came back. Over about 3 months, I deposited $792. I was doing it much smaller than what I was doing it the first time. Then I stopped again. The important thing about May 2020 is that I didn't buy the bottom. The S&P 500 hit its COVID low on March 23rd, 2020. By May, the market had already recovered about 29% from the bottom. I caught the early part of the recovery. Then nothing until it started again. I told myself I'm going to deposit $500 a month, committed to it, no gaps. That's been running about the last 10 months. And this time I was trying to find my process. I was trying out high yields. I was selling options. I was reading into the buy, borrow, die strategy. And my portfolio is now at 8,100 today. 2 starts, 2 stops, about 5-year gap in the middle. Now let's look at what it costs. $1,398. May 2019, left in SCHD with dividends automatically reinvested. SCHD actually returned each year with dividends included. In 2019, 27.29%. In 2020, 15.03%. 2021, 29.87%. In 2022, a negative 5.56%. And then in 2023, up 4.54%. 2024, 11.66%, 2025, 4.34%, and 2026, right now, January through April, we're at a 15.11%. That $1,398 sitting there, compounding through every one of those years, reinvesting every dividend. By April 2026, that number would have been approximately $3,243. I didn't spend any money on anything. I didn't lose it. I didn't make a bad trade. I just logged out, moved on. And that $1,398 never became that $3,243 because I didn't stay. The market didn't care whether I watched it or not. It ran the same returns either way. Now let's look at it as what my 2020 deposit would be if I would have held the same exercise with the $792 that I had. I deposited in May 2020. The return from the COVID crash was already underway. From May 2020 to April 2026, SCHD returned a whopping 89% total with dividends reinvested. From May 2020 to April 2026 would have been worth about $1,495. That's nearly double. I just needed to stay, and I didn't. Now we add both together, that $1,398 in May 2019 and that $792 in May 2020. That adds up to $2,190 total invested. If I would have held both of these deposits without touching them, they both would have been about $4,738 today. No additional deposits, no strategy, just hold what you bought. Now the hard version. What if I never stopped? What if I started in May 2019, stayed consistent, and put in $500 a month, every single month, all the way up to today? Total investment would be $42,000 total invested, $500 a month into SCHD dividends reinvested automatically. In 2019, 8 months of deposits, SCHD returned 27.29% for the year. End of 2019, roughly $4,311 in the portfolio. In 2020, 12 more consistent months, SCHD returned 15.03%. End of 2020, roughly around $11,359. In 2021, SDHD had the best year in this window, returning 29.87%, ending in 2020 roughly around $21,513. In 2022, SCHD dropped 5.56%. That's the only negative year in its stretch, but notice what happens. The end of 2027, roughly $26,019. This portfolio went down in value on paper, but the deposits kept coming in. $500 a month in January, $500 a month in February, all the way through December. Those deposits were buying shares at a lower price. That's the whole point of dollar cost averaging. You keep buying, you pick up more shares when the price lowers, and you're setting yourself up for a good recovery. In 2023, a quiet year, SCHD returned 4.54%. End of 2023, roughly $33,000 in profits. In 2024, a solid year of 11.66%. End of 2024, you roughly had around $43,590. In 2025, another quiet year, 4.34%. Ending end of 2025, roughly $51,649. Then in 2026, January through April, SCHD is up 15.11 year to date. Ending of April 2026, roughly around $61,500. My portfolio today is at $8,100, and that's a difference of around $53,000. $42,000 in deposits grown to $61,000 versus $8,100. The gap between those two numbers is unreal. So why stop and cost more than you think? It's not just the returns you missed, it's what those returns were supposed to compound into. When you stop investing, you lose year one being reinvested. You lose the dividends from years one, buying more shares. In year two, you lose those shares paying dividends in year three, and you lose the compounding in year four. That chain runs for every year you're out of the market. And in my case, 5 years, the 2021 rally was 29.87% on SCHD. If I'd been in the market, the gains would have built on top of that year, compounding in deposits. If my portfolio had been at 21,000 going in 2021, at that 29.87% year means I would have got around $6,200 in gains. I wasn't even in the market, so I had essentially nothing there. That $7,200 in gains never happened, and neither did the years of compounding after that. This is what people mean when they say compounding is exponential. The base you miss building during the years you're out is magnified for years after. The smaller base means every future percent gain produces fewer real dollars. The 5 years I wasn't in the market in 2020 through 2025, those years still happened regardless. The market ran its returns. The shares compounded, the dividends reinvested, and I wasn't there. Around $54,000 isn't the cost of missing a few years, it's the cost of removing my deposits from the compounding engine and letting the engine run without fuel for 5 years. I came back in May 2020 because I saw a buying opportunity. The market crashed. I was paying attention. I deposited around $792, and then I stopped anyway. Not at the worst moment, not during the peak fear, not at the bottom. I re-entered after the bottom, catching the early recovery, watched the market move back up, and still quit. SCHD was roughly $41 to $42 per share in May 2021. It's at $31.31 today, but only because of the 3-to-1 stock split in October 2024. And the total return since then includes reinvested dividends is a whopping 89%. That lesson isn't I should have bought at the exact bottom. That lesson is that I had a good entry point, a recovery already in progress, years of runway ahead, and I still walked away. Time in the market is hard. Staying in the market is easy. I failed at the easy part twice. Look at what happens in 10 months since I started in June 2025. Portfolio went from 0 to 8,100, and I catched it close to the bottom. The markets move. I got lucky with my timing of started, but the mechanism is working. Shares are compounding, dividends are reinvesting, and the portfolio is growing. If I put $500 a month for the next 7 years through 2032 or so, the math still builds. The best time to start was in 2019. The second best time was to start in June 2025. The third best time is today. That's not empty motivation. That's just how compounding growth works. You can't recover the years you missed, but you can start the clock on the years ahead. Every month you're in, the base grows. Just consistency from wherever you are. I want to connect this to a bigger picture of what I'm building. The bill stacking plan isn't just picking ETFs. It's built on one assumption that has to hold. The collateral keeps growing. Phase 1 unlocks at 6,000, one bill on the loan. Phase 2 at 10,000, phase 3 at 14,000, all the way up to phase 10 at 145,000, where every monthly bill runs off my margin loan and the dividends cover the interest. Every phase requires a bigger portfolio than last. Every phase takes longer to reach if I'm not making deposits. The margin loan works because the dividends cover the interest. The portfolio base grows because the continuous deposits and reinvested dividends. If I stop depositing, even for a few months, the phases don't just pause. They slow down because the dividends stop compounding in the new capital. The loan interest keeps running, the coverage ratio stays flat or shrinks, and the gap between where I am and the next phase gets harder to close. For someone running a pure dividend portfolio, more growth than dividends, stopping is expensive. For someone running the buy, borrow, die on top of dividend portfolio, stopping is dangerous. The margin loan changes the math. The loan interest compounds against you whether you're depositing or not. The collateral base has to keep pace. This is why I never frame stopping as taking a break. You're either building the base or falling between on all the phases. I spent 5 years falling behind. The chart shows exactly what that looks like. But I want to close on something that's been on my mind since I first start pulling this data together. If I started in May 2019 and never stopped, consistent, disciplined, no gaps, I probably have around $60,000 in my portfolio right now. Quietly compounding, nothing dramatic to document. Almost Wealthy exists because I don't have that story. I have this story instead. The one where I started twice, stopped twice, lost 5 years, and have $54,000 less than I could have had. The one where I'm still in the early phases, where the gap is real and the ground making up for it is real. That's the actual journey. And I think documenting the actual journey with the mistakes visible and the cost calculated is more useful than showing up once and already having it figured out. This video exists so you can see that number as a real calculation. $1,398 plus $792 in deposits, $2,190 total. If I held them, $4,739. If I'd done the $500 a month the whole time, that would have been around $62,000. What do I actually have now is $8,100. That's a gap between roughly around $54,000. 5 years, $54,000. That's the cost. So if you've taken a break from investing and you're trying to decide whether it's worth restarting, I hope this number is useful. Not as a reason to beat yourself up, as a reason to not stop again. So my count right now is around $8,100 in my portfolio today, $54,000 less than I had if I would have stayed consistent in May 2019. The math doesn't lie. Stopping has a cost. The cost compounds the same way returns do. Every year you're out, the gap gets harder to close. I can't recover those 5 years I missed, but I've been consistent since June 2025. $500 a month, every month, dividends reinvested, phase stacking. Phase 2 is almost near. I'm about 1,800 away. The chart looks a little different now than it did in 2020. That sharp climb on the right side, that's what not stopping looks like. That's what I'm building. Subscribe if you want to follow along. I post every week with real numbers from my actual account. No theory, no hypotheticals, just where my portfolio is and what the numbers say. See you on the next one.